Hello and welcome back to Game of Trades, your #1 channel for videos on the stock market and cryptocurrencies. This video is going to be focused on the SP 500 that is currently breaking out above this downtrend. So is this the signal that everybody's waiting for the resumption of the bull run as we resume off this 200-week moving average, this bull market moving average? What's interesting about this current move is that the insider transaction ratio is actually going through the roof to the highest levels seen over the last year. So last time we had quite elevated levels was in August. That was almost a perfect timing in terms of the top of the market. So we're going to take a look at that in this video. I think it's important to look at this type of data very objectively. We're going to dive into what information this actually is giving us regarding the market, why they're actually doing this, and what it means for us as investors. By the way, if you are new here, don't forget to smash that subscribe button. And of course, if you enjoy this episode, smash that like button. Now, without further ado, let's get right into it. So before we actually backtest what insiders have been doing here over the past week and look at and how accurate they have been at timing the market. By the way, insiders being corporate insiders, so they have access to information that the public may not have, inside information. And so these corporate insiders have to disclose when they are buying and selling stocks. And that's why we have these types of charts to help us understand what these corporate insiders are doing. Now, just as a natural instinct, you would say that if insiders are selling right now, it perhaps means they know something that we don't, that their companies are weaker than what the market is currently pricing in. And so that would be generally bad for the market. So let's try and understand if that's true. This chart here is potentially going to give us some insight into this whole story. This is a chart that was shared by Gavin Baker. He posts some very interesting stuff on Twitter, so make sure to follow him. What this chart essentially shows is how the S&P 500 has reacted to beats and misses on S&P 500 earnings reports. So it's been earnings season recently, and that's why the market has actually been going up, because earnings have actually been pretty strong and stronger than what the market has been expecting as a whole. It doesn't yet seem that corporations are really seeing contractionary recession type of numbers in their balance sheets. But if we dive a little bit deeper into the actual dynamics, you can see that stocks that actually reported good earnings, so EPS beats, reacted very poorly. You can see this line going down means the reaction after the earnings report was very poor. And very interestingly, you can see here the companies that reported a miss, those actually had a lot of strength here. So you could say it's been a very irrational type of earnings season. You can see, for example, here in 2009, this was around the bottom of the global financial crisis. Companies that were reporting strong earnings were outperforming significantly. They were seeing big price bumps. So this is a very unusual earnings season and potentially actually gives us some context around this chart here showing insiders that are selling their stocks right now. If your company just reported poor earnings and company numbers are currently telling you that you're probably going to see those numbers get worse and worse over the next few months as we head into a recession, we're going to talk about that in just a second. But you see your stock price going up in reaction to those poor numbers and that poor earnings guidance. What do? Well, you sell. Potentially that's what's happening here. We're just trying to paint a story around the data. We don't actually know what's going on, what the thought process behind these transactions are, and whether they actually mean anything. So all we can really do is backtest this chart, see how accurate they have been in the past. And just looking at these first couple of big spikes that we had throughout 2022, look at where they are towards the end of March and towards the end of August. Now, of course, we all know what those correspond to: the end of March right here and the end of August right here. So evidently not great moments to be long in the market right here. Now, I looked everywhere online for a chart that goes back further in history than this. Unfortunately, that doesn't seem to exist, so we can't really do a proper backtest. But I found this chart here of 2015, right? This is a chart of 2015. So January 2015 all the way to November of 2015 right here. Now, if you know your stock market history, you'll know that this was quite a volatile period in the market, right? And you can see here January 2015 all the way to November of 2015 right here. So lots of volatility here. And right after that, lots of volatility as well. So let's see how accurate insiders were in this period of volatility. So first of all, between January and all the way to May of 2015, right here, insiders were selling constantly. So that first round of selling from insiders came right here throughout this period, January to May, as the markets were climbing very gradually here, insiders were selling. You could say that they timed the top perfectly. They then proceeded to sell again at the beginning of July, right here in July, whereas that on this chart, it's right here. So insiders timed the top right here, the top of this bull market perfectly, and they also timed the correction perfectly. They then stopped selling until the second half of October and the beginning of November of 2015, and you can see where that is right here, October, November. They were selling once again here, betting that the stocks would get cheaper, which of course they did right here in January of 2016. So I haven't given you any information other than what the charts are actually saying, when they actually sold, and perhaps why they could be selling now. It doesn't mean that they're going to perfectly time the market again, but the goal of this video is to give you that data. And now, of course, I want to get to the best part where I actually give you my opinion. But before I do so, don't forget to smash that like button as hard as you can. It does help the channel out massively. So if you appreciate the effort that goes into making these videos, don't hesitate to do so. Now, the probability of a recession right now, based on the yield curve, predicted by the yield curve, is the highest now since 1981. Now, by the way, I always find these charts funny because it says the probability of a recession is around 50% right now. I don't know how they come up with that number, but you can already see it 30%. Every time the probability gets to 30%, you do get a recession. 2020, 2008, 2001, 1990, 1981. The only exception being 1967. But so the data seems quite compelling right now. We are heading towards a recession. The probability of it is elevated. And so while earnings have been strong in this season, we do think it's only a matter of time before they begin contracting, like a good old-fashioned Fed-induced recession, where the Fed tightens, it hikes its Fed funds rate, and it causes a contraction in earnings, which we have not seen in 2022. So the macro environment is starting to look ugly. So while we were constructive on stocks towards the end of 2022, because we were seeing inflation that was coming down, and there was a reasonable probability that the Fed would begin reacting to inflation coming down and economic data, but they have been acting very tough, keeping a lid on PE ratios that have not been able to expand during this window of opportunity, this pre-recession window of opportunity where inflation is coming down, the Fed can potentially pause and the market can price in that pause, and that can let the market rally before the recession. Now, the problem is that window is getting very, very narrow now. We're getting very close to that moment where earnings are going to start declining, and that's going to start putting pressure on the market, even if the Fed pauses. Declining earnings is bad for the market. We saw that in the 2000 bear market, and we saw that in the 2008 bear market. If earnings are declining, the Fed can do all it wants in terms of easing monetary policy. If earnings are moving down, the market is moving down. But as traders, as technical analysts, we also want to respect the trend, and we want to let our winners run. The SP 500 is now above its 200-day moving average. It's above its downtrend line resistance. It's also in a bullish structure right here, bullish upward structure. It's also above some key supports like 3,900 points right here. So for now, although the macro environment is deteriorating, it still makes sense to be tactically bullish as long as the market remains above these levels. We've had some great trades on tech, consumer discretionary, transportation on the model portfolio on the website. These US equity trades were really designed to outperform the market when we added them around the market bottom, right? Each of these were added towards the end of September, right as the market was testing its 200-week moving average, building some nice divergence on momentum indicators and hitting big oversold readings on the breadth, signaling that it was marking a bottom. We want to book the profits on those trades when either the market gets overextended to the upside, we think it's too expensive, or if bullish structures are broken, and that's when we want to get defensive in a big way as we prepare ourselves for what's coming in 2023. This is why we do what we do every day at Game of Trades. We want to find the best trades that have the best risk reward through our research process and give all you guys access to that information, taking you through the process of beating the market. If you want to stay updated and notified on all of these developments and and what our strategy is in the near term, how we're going to be positioning the model portfolio in 2023. Make sure to grab the free trial by clicking on the link down below. It is completely free and you can test out our service. Now, that's about all I wanted to cover in this episode. I hope you guys enjoyed. If you did, don't forget to smash the like button and subscribe to the channel if you haven't already. Now, in the meantime, I wish you good luck on your trading and see you next time.